Everyone expects this avalanche of distress coming, and we've got a whole pool of money, we're going to buy all the stress. That never materialized. The debt funds have sat on their hands, twiddling their thumbs for a couple of years now. They're sitting with a ton of money and they're eager to transact.
If you're looking for yield, investors are looking for yield, it's a great market.
Those markets that were the belle of the ball, today those markets aren't the belle of the ball. You write off a big city at your peril. You've got to be on your toes. You can't get complacent.
It's kind of a herd mentality on equity. So that said, these funds have a life.
We see ourselves very much as an extension of our clients. We're out there with you fighting that fight.
We'll rename the pod People Flow Friday. All right, boys. Henry, Ricky,
Good morning.
how we doing?
Great. Looking forward to some nice winter vacation time.
Yes, this is the season right now.
Last days of the
I
year.
think, Ricky, you need to be here full time in between November and
The winter
May.
months, dude. The winter months.
Yeah, exactly. The winter months. New York's not too bad when it comes spring.
Yeah.
How was breakfast with Max?
It was great. We spent
Yes.
2 hours together. Covered a lot of stuff to get done in the future. Very exciting. I like Max. He's a good guy.
Yeah, Max walked in. He's like, had breakfast with Henry. It was amazing. It was 90% non-real estate, 10% business. But the 10% is good business, which is great. And
I think you also need to have a connection with someone, right? So it's good to have that connection because that connection solidifies, and then use that connection. You also have a lot of business chat, but you want to kind of get to know the people you're dealing with. I always
100%. It's a relationship business.
always say in this business, especially with one of the last humanistic businesses where we're a commodity business, we do the same thing as a million other people do in the industry. It's that person-to-person connectivity, that feeling one has for the other that drives the business. So
100%. 100%. I think there's so many deals to go around. There's so many markets, and the pod is all about diving into deals, diving into markets, talking shop. But end of the day, meeting face to face, talking to people, it's about who you're dealing with is just as important on what the opportunity is. It's about dealing with people you want to do business with and avoiding people you don't want to do business with. So
life is too short to do business with people that make your life miserable.
Amen. Amen. Guys, thanks for hopping on. But there honestly doesn't need to be introduction. When I talk to people and I'm like, hey, do you know Henry Ricky? Like, who doesn't know Henry and Ricky? Honestly, you don't even need a bio, but let's talk to me about what you do, your team, how you've been building your brand. Just give us the high level overview.
Okay, so British born, moved to New York in 2002, 2003. Initially came here for a 3-month internship and was meant to go back home and work at the family business. Came and never left. Did various different things. Was in private equity for many years. After the crash of 2008, I was very turned off from finance, lost a lot of money for investors like everyone did in the crash of 2008. You were probably still in high school, I think. And I wanted nothing to do with anything financial, went into a completely different business, went into the nightlife and restaurant business, opened 3 nightclubs and a restaurant, did that for many years, built a few very successful spots, very well known. And then in 2015, 16, my wife wanted to have kids and she didn't want me coming home at 4 or 5 in the morning. She said it was time for a change. Told me to go see a gentleman called Anthony also at Cantor Fitzgerald. Went to see him. He said, I can't give you a job. I'll give you an internship. Gave me an internship at Cantor, started to learn the business, started to develop my business predominantly on the multifamily side, started to build a good book of clients. Then in 2018, Anthony got transferred from Cantor to Newmark because Howard Lutnick rolled all these different companies into Newmark, took Newmark public. We went over from Cantor to Newmark and I joined Newmark. And then we really started to take off, working together with the investment sale brokers across the platform, introducing them to a lot of New York buyers who are losing faith in New York because of the draconian rent regulations. We started bringing them to markets such as Columbus, Florida, Atlanta, the Texas market, and that really started to drive our business. Became one of the most successful and most aggressive lenders on the multifamily side. Today, I think we've done over $15 billion of multifamily loans. We've been number one or number two on the multifamily side year over year. This year we'll close a little over $3 billion, even in a down market. We're very entrepreneurial, very aggressive for our clients. We don't believe it's ever about the deal. We believe it's about the relationship. And we look to find ways to drive revenue to our clients, because we feel rather than just wait for clients to bring us deals, be an active source to bring opportunities, be it on the acquisition side, be it on the debt side, be it on the pref equity side, be it on the equity side. Find ways to bring money to our clients, and that way it drives money to us and the firm.
Yeah. And just, I guess, to piggyback on that, how much of your business right now is equity focused, pref equity focused versus debt focused? And talk about some of the programs that you guys have been able to get done.
So obviously the best game in town is Freddie Mac and Fannie Mae, right? They've got a ton of liquidity. They're there for the multifamily sponsors, good multifamily sponsors. So our core focus is obviously providing great agency execution. But in today's market, you have to be incredibly smart. We have a deal closing, and Ricky, you can talk more about this deal. We have a deal closing tomorrow where Ricky was instrumental from the beginning. And what we did is just the craziness. We did the workout from the original bridge loan with firm. Once we worked out the deal with the bridge lender, we brought him an agency loan plus a pref equity on top, with a hybrid part of that pref equity being common equity, and we're closing that deal tomorrow. So from birth to death, we are here for them. The loan was in severe distress. We sat with the lender, figured out a plan with the lender, stopped all the problems they were having, then moved it away from that bad bridge loan into a secure 5-year fixed agency loan. And then also, because it didn't cover, worked with a pref equity and an equity provider to cover the whole stack. And Ricky did that from nuts to bolts.
Nice.
Yeah, it's great. I mean, it didn't cover on the pref side too, which is why you kind of bring in the hybrid equity. A lot of groups doing that. I think you're really seeing that for these deals in 21 where the debt's worth more than the asset. So in some cases, when there's still a lot of value add to be done, a lot of these equity groups could get a little creative there. And I mean, it's a great structure. There's a lot of groups doing it. And I think 22, 23, 21, 22, 23, all those loans that are going to be maturing the next 2 to 3 years, you'll see a ton of that.
Yeah. And do you think these are going to be more acquisitions or recaps, or a little bit of a mix of both?
I think it's recaps.
Yeah.
Anything on the acquisition side, we're not really seeing much pref unless it's, maybe construction. But outside of that, no, it's a lot of the recaps.
On the acquisition side, you've just got to be so fine. You've got to tread that line so brilliantly. It really is picking a needle out of the haystack. You're on the acquisition side. You put a lot of, you do a lot of work. It wasn't like it was 2, 3, 4 years ago where everything made sense.
For sure.
Today, with where rates are, with where cap rates are, where insurance costs are, you really need to do the homework. So you're seeing less on the acquisition side. It's very pinpoint on the acquisition side. But on the refi side, you've got to be very thought out.
Yeah, definitely. I think it's been a very active year for you guys, and it's been an active year in real estate, but not necessarily in acquisitions, right? There's so much liquidity still out there, but they're targeting more of these recap or rescue capital opportunities, and you're not really seeing it translate from a distress side all the way to a sale.
No.
There's options A and Y before you get to Z, which is a sale.
We've seen the common denominator is that banks and lenders are not eager to take back properties. In the worst case scenario where there's been bad boys and pref on top of pref, you see lenders take back, but most lenders are happy to work with you and work with the borrower to find solutions rather than take back keys.
Yeah, it's interesting. If it's operationally distressed, the lenders don't want to take it back. If it's operationally performing, the lender's saying, okay, well, it's the sponsor's probably going to be managing better than the lender would be doing it. And so there's kind of both sides of it where the lender doesn't necessarily want to take it back for one reason or another.
You have to show gross negligence and gross incompetence for a lender to want to come in and step in and take back the property.
Yeah. And you're just not seeing that translate to sales. Another thing we're noticing on the acquisition side is when there is a distress deal for sale, it gets completely bid up because people like to pay for the story.
Right.
And it gets to a point where you'd rather buy a deal that stands on its own 2 feet at the same in-place cap than what that stabilized return on cost looks like.
And the lenders know that, right?
Yeah.
So you're not seeing a ton of loan notes. You're not seeing a ton of note sales. You're just not seeing, everyone expects this avalanche of distress coming, and we've got a whole pool of money. We're going to buy all this stress. That never materialized.
Exactly. There's so much money earmarked, right, for distressed, and that's why they want the story, and they'll overpay for it because it's part of their mandate.
Correct.
Still feels like that opportunity is not there. I think what you guys did with Bridgewater, I mean, that's the real opportunity.
Yeah, Bridgewater was a good one.
I mean, you bid on these marketed deals, and they keep falling in and out of contract, and you stay consistent on where you are in price, and your equity spoken for, and that's really the deals that transact below Whisper.
Yeah, I mean, Bridgewater was an awesome deal we worked on together. One thing I loved about Bridgewater was it was operationally performing really well, but it was a cap stack issue, and it wasn't even property specific, but it was just more liquidity. Owner was in a bind. It was peak fear during that time with October 7th, and the treasuries were at 5%. And we were able to see through that a bit and see how the asset would be great long term. And you guys were instrumental in getting us through the finish line with a great Freddie loan, rate locking when there was a bond rally, and helping us through the whole stack. So thank you guys again.
You'll find me on the phone, and Ricky can attest to this, screaming, rate lock now. You've got to find that window, and many times we'll close the deal and we'll put the flyer out, and I'll say 513 all-in rate, and the guys will come out and say, "You'll see, how did you get that done?" Because we are watching for that kind of that dip, and then we're scrambling. We tee everything up to take advantage of if there is a dip that you rate lock at that moment.
Yeah. So we timed it perfectly on Bridgewater. We closed the deal a couple months ago in Atlanta where we stuck the landing on the rate lock. It's great.
Such a good feeling.
You can't bank on it as a business plan, obviously, but it does make a good deal great.
Yeah, but in this market, you're going to see such crazy swings. Like, look, over the last 3 days, what have we seen? The 10-year go up 30 basis
10 years at 4.5 right now.
Yeah, so it's gone up 30 basis points. And the Fed lowered Treasury, but what they said was more impactful, that they don't see rates coming down in the long term. So that spooked the market. So there's always going to be these things. And then January, Trump will get into power. He may say something like, "I'm going to tell the Fed what to do," and you'll see rates come down. So you've just got to be really, really geared to watching for those opportunities, those dips to take advantage.
Yeah. So we're at an interesting point in time right now, December 19th, 18th. Yeah, 19th. And the Treasury's at 4.45, 5 years at 4.4, and SOFR is at 4.4. And I think what you're starting to see is SOFR now starting to be lower than Treasuries. Do you think that's going to translate to a different type of program being let of like people either getting back to bridge or floating because of how things are switching from Treasury versus SOFR?
Not yet. We need SOFR to come down a little bit more because still the delta between floating rate money and fixed rate money is still quite wide. The spread on a fixed rate deal with a buy down can be 105 to 120, 130. The floating rate lenders are still 200 plus over. So we need SOFR to come in more. And then you're also not seeing a lot of heavy value add deals getting done right now. The market for value add deals is kind of gone. So what was the norm in 2020 was people buying these 80s vintage deals, getting the bridge loan money that will fund 100% of the CapEx, going in, fixing the units up. That business has kind of died, and everyone's kind of buying newer vintage and gambling on rent growth and kind of better operations. So we're going to need some very large shifts for us to go back to the 80s vintage value add heavy game, for people to go back to floating rate debt funds or floating rate agencies. So I think we'll still continue to see 5-year fixed. Would you agree with that?
I think on the lease up deals, you'll start seeing a lot more floaters being done.
Yeah, like a lease up
the agencies pull back on their near stay programs, and it's just getting harder and harder regarding sponsorship. And that capital is cheap. I mean, 260 spreads on some of these deals.
Because it's better quality product, and so they'll get a little more aggressive on that.
Definitely aggressive on sizing, right? It's just such a liquid market. So
the debt funds have sat on their hands, twiddling their thumbs for a couple of years now. They're sitting on a ton of money, and they're eager to transact.
Yeah, and it's a good play for a buyer, given that you'll probably get actual premium in stabilized cap than something stable, because lease up risk, depending on the market, is real, right? Like there's a lot of supply in a lot of these markets. Some a little bit feeling a little bit more pain than others. There's concessions. So I'm sure you should be getting a stabilized cap that's better than if it was 100% leased up.
Right, but think of someone built a $170 million development, right? His construction costs are, let's say, 8-9%, right? And now he can go in and get a floating rate bridge loan for lease up, and he's at 200 over. So now he's 150 basis points, 200 basis points cheaper than his current debt. Why not get out of your construction loan, get rid of all the PGs, put on this floating rate debt, give yourself a nice window to lease up without having to be too aggressive with concessions. So that could be a big play as well in 2025.
Yeah. So you think the floaters or the bridge is probably it's going to stay more on this better quality stuff. And it's going to be probably a while till people will ever take bridge debt on value add and banking on a return on cost and ignoring the in-place cap.
I think everyone got very burnt by SOFR widening at such a pace, right?
For sure.
And then the cost of cap rates going through the roof, which they never expected. You were 3 years ago, SOFR was at 10 basis points, then it went to 530, right? And your cap was $60,000 and your cap went to $700,000. So I think that really scared a lot of people, and there's PTSD in the market because of that.
Yeah. Good question for you, though. I mean, on the investor side, is equity trying to do value add deals right now? And are you guys penciling that?
No, I mean, the two deals we bought, Orlando and Atlanta, there's a value add component, but it's gravy, right?
Those were good going in cap rates.
Yeah, they were all strong going in cap rates, positive leverage day one, well into positive leverage day one. And they can stand on its own 2 feet. Didn't need to bank on the market recovering, didn't need to bank on rent growth. You're cash flowing, worst case scenario, and best case scenario, things improve. And that's the complete shift, right? During the zero interest rate period, people were banking on a return on cost. They were ignoring the in-place cap. You were looking at stabilized numbers. It was basically buying a vacant building almost and just saying, all right, who cares what the rents are in place?
Right.
Like
they mean nothing.
They mean nothing. Everyone was looking at trade-out reports. Trade-out reports were so important. Now it's completely opposite. So I agree. I think equity is looking for solid deals that are at good bases compared to peak values and also compared to replacement costs. And then yields that are very strong relative to borrowing costs. So if it's a newer vintage asset, maybe it's slightly negative leverage, but with a path to positive leverage.
Right.
And on maybe something older, it's positive leverage day one.
Yeah. And that's what makes this business so fun is its fluidity and how it changes and how what can be the cream of the crop one day is suddenly forgotten. Like even with markets, right? If you remember 3 years ago, those markets that were the belle of the ball, today those markets aren't the belle of the ball. Like Austin was just untouchable. Today you've got a tremendous glut of overbuilt product in Austin, 3 months concessions. Nashville, no one could say a bad word about Nashville. I'm not saying these markets are bad today.
Yeah.
The mindset is different. But then if you look at the Rust Belt, you look at the Midwest, those markets are very much in vogue. And Chicago is the contrarian play, but no one overbuilt like crazy in those markets. And you're getting really, really positive rent growth. So you've got to be on your toes. You can't get complacent and think, oh, I'm in Florida, I'm good. That's not the story. It's always, where is the next opportunity? Where can I make money for my investors and my clients?
Yeah, I mean, I'll put the question to you. Where are you guys bullish on heading into 2025, and where are your clients seeing success in?
Do you want to take that?
Columbus, baby.
Yeah, I'm hearing that a lot. I think you're going to hear that a lot in NMHC. But what's your take on that and Columbus? Do you agree with that, or is that kind of the sentiment?
Yeah.
No, the fundamentals are so strong.
You got to tour it and see it for yourself too. I mean, I toured it and we were doing so many deals there, just kind of waited. And finally, when I got there, you have Ohio State, you have Intel being built, you have a lot of good economic drivers there. And you look at the rent roll, we see a million of those, and there's positive trade-ups. So exactly what you're saying. If you're looking for yield and investors are looking for yield, it's a great market.
Yeah. I mean, I'm not as in the weeds with Columbus as we are in some of our other markets. One thing I hear that's great. It's always been steady. It hasn't had the supply glut that some of these other markets have had. And it's just chugging along. You
didn't have the cap rate compression. People did insane things in these Sunbelt markets. They bought stupid cap rates, right? And that never happened in Columbus. So you don't have that pain. It was always a very steady market.
Resilient.
And slow and steady, literally, it's what your dad tells you when you're a kid. You never understand. Slow and steady wins the race. And now you see it as you get older. Markets that are just good, strong, stable markets with very good fundamentals, they are going to weather the storms and be through the test of time. Where these markets that just are boom and bust with a ton of land and easy to develop, those are going to be more challenging for you.
Right. It is a key difference between trader markets and maker markets, right? Which markets are you gonna quick flip out of? And like, those aren't bad markets, right? But you got to be careful with what you're buying. And
then you have standalone markets. Look at what's going on in Miami, right? New York is always going to be the epicenter of the world. So there are those markets that just kind of stand alone. They will also be there in the long run because they just have something that other cities don't have.
Do you put LA in that category? I know, like,
I think I put Miami in this category. That's nice.
Yeah. I mean, Miami's amazing, honestly, moving here.
I think you write off a big city at your peril. I think you make a mistake of saying, oh, San Francisco's dead, and you make that at your peril because San Francisco has the brain trust, right? Just so close to all these universities that put out all the tech and Silicon Valley. You do the same thing with LA. LA is the epicenter of entertainment, the entertainment capital of the world. You can't write off these markets. Yeah, they're going through turbulent times. There's some political headwinds. There's some other ideologies that could cause problems. But at the core, there's some really strong fundamentals there. We're doing a $5.2 billion deal in California right now in Los Angeles. Our team, it's called One Beverly Hills. It's a condo, hotel, retail development.
Old Robinson's, man.
That's Oco and Kane and Alman.
On the on the corner of
it's because there's the Hilton Hotel and the golf course. The last undeveloped piece of land, 17 acres.
Yep,
it's a behemoth, and that's going to break every record. And those guys are really, really smart. They know what they're doing, and the lenders know what they're doing. So if someone's going to lend $5.25 billion, they're not writing off LA. So don't write off these cities. Be cautious if you want to, but be very careful before you write off cities.
It's better than they've ever been, too.
Yeah, that's true. That's true. That site, first of all, is one of the most incredible sites. Just growing up in LA, I would play soccer right across the street in El Rodeo when they were demolishing the Robinson's Bay and the Chevy and the gas station that we would always get gas at.
That's
it's gonna be way better now.
That project's going to transform a city, right? You know, the first Amman members only club, redoing the Hilton, huge $700 million renovation where the Oscars are held. Then this unbelievable retail corridor with shops and restaurants, and all surrounded by a 10-acre man-made garden with springs and brooks and valleys and all that. It's going to be sick.
Yeah, and I'll just go back to what Ricky was saying. Like, the cap rates you're seeing in LA are really attractive. We were bidding on a deal in North Hollywood that was recent construction. We got outbid, but it was almost a 6 cap on our numbers for new construction.
Yeah,
and yes, you have the political, the regulatory, you have ULA, you have some of these other California ballot initiatives, and they just keep coming. And as a syndicator, it can be hard to underwrite some of these, some of that risk.
It can get crushed overnight with some crazy regulations that comes in. That's what happened to New York.
When the rules are changing in front of you.
Yeah.
So in New York.
Yeah, but look at New York today, the highest rental cost in the country. You know, 1 bedroom. What are you paying for your 1 bedroom in New York City?
$3,500.
That's insanity.
Yeah.
Right? When I first moved to New York, my rent was $800. So you have incredibly strong rent growth in New York with all the headwinds. You know that it's so hard to find an apartment in New York. It's literally like hand-to-hand combat. Every time a unit comes online, there's like 30, 40 people queuing outside to go see it.
It's a broker fee war too. I gave my broker 20% just to move in.
So would you guys say, I guess as a contrarian view, that you guys are probably like bullish on some of these markets that people are writing off, or that there's opportunity there?
Our job is as an advisor is to know the markets, know everything that's going on with the market, and then advise the client what we think is great. It's not our job to tell them where they shouldn't invest. It's our job to tell them where we think they should be investing. So we're never going to be down on any city or any. We're just going to do the homework. We're going to look at the reports, understand what's coming online. We're going to take educated positions, and we're not going to say, oh, this is a good market, this is a bad market.
Exactly.
You never know what's a good market till you do the work. So where would I tell you to invest right now? I would say I love the Midwest. I think the Midwest is having a moment in the sun. I think these markets are severely undervalued, and there's a ton of demand for them. So we're incredibly bullish on that market. Am I sour on Dallas? No, because there are some pockets that you can make great money. Am I sour on Austin? No, there's always going to be deals. All I'll tell you today is, as an acquisitions guy, do the homework.
Yep.
Do the homework. Don't be aggressive in chasing a deal because your emotion. do the work, understand the in-place rents, understand what's coming online, understand what your competitors are doing, and then we'll help with you, we'll work with you, we'll help you understand the market better, and all together we'll take an educated position on what you should be doing.
Definitely.
I'd add invest your time in what Tryon is doing, creating a fund.
Yeah.
You're seeing so many sellers and so many investment sales brokers not award deals because guys say they're syndicators. So I think if you create a fund and say the equity spoken for, it gets past a lot of the question marks, and it kind of opens up your flexibility on a business plan and what markets you can enter.
And that should be very nimble, right? That should be very aggressive, very nimble, and move very, very quickly. Most of the deals that were awarded this year, the capital was raised and there because sellers understand with these huge fluctuations in treasuries, a 3-month window where you award a deal and the deal doesn't get done and treasuries are blown out 60, 70 basis points, kills your chance of resale in 3 months' time. So they want to go with surety of close. So if you have the ability, I'm going to sign the PSA in 2 weeks, I'm going to go hard deposit in 4 weeks, that's going to make the seller much more comfortable. It's going to help you win business.
Yeah. And I would say, pre-rate hike, you were seeing that all the time. It was like non-negotiable. You had to go hard day one. Are you still seeing a lot of that in this environment?
You're not seeing as many acquisitions as you were. So the acquisitions that you do see happening are going to the surefire bullet, are going to the ones that are just so ready to go, have their money raised, have all their ducks in a row.
Certainty of close.
Certainty of close. That is the most important thing, because we've seen guys get burnt with buyers that have just schlepped them down.
And it comes with reputation too, right? It's not just what you put pen to paper on a PSA. It's about, all right, what was the last deal you did? Did you retrade? Did you not? Why not? And I think going in honest goes very far in this business. I
think people have retraded. Obviously, if spreads have blown out 90, 100 basis points, that there has been the occasional retrade, and I think sellers understand that because they're also buyers a lot. They're doing the same thing.
Yeah,
I think honesty and just
honesty.
Just saying, listen, I've got room for 40 basis point swing. It goes over 40 basis. We're gonna have to talk.
Yeah, exactly. Very true. So going back to what you guys are saying of advising your clients, what's some of the best advice you're giving your clients heading into 2025?
I would say fund. Really, like if you can get your equity lined up, the world becomes your oyster regarding acquisitions. And on the recaps, it's identifying what covers with pref, what covers without pref, understanding, where values are and really getting creative and forward looking on, okay, how do we shift our business plan to exiting in a year or two, restructuring this on a 5 or 7 year outlook.
Definitely.
I've been saying the same thing since day one. Communication is key, right? You've just got to communicate with everybody, be it your investors, be it your lenders, be it your brokers. When things are bad, the guys that fail are those that bury their head in the sand, the guys that go into the fetal position in the corner, don't want to deal with the problems. You can't be like that. You've got to have courage. You've got to be brave. This life is full of ups and downs. It's peaks and valleys. Sometimes it's great and everyone's at the top of the world, and sometimes you're at the bottom and you're like, how the hell did this happen to me? Keep lines of communication over. And that's being on the acquisition side. Let's say you're chasing a deal and things don't work out. Don't put in an offer and then disappear, right? I can't stand guys that just disappear on you. Just keep communication open. Talk to your lenders, talk to your brokers, talk to your sellers, talk to your investors. If you do that, everything will be fine.
Yeah, it's true. It goes back to what you're saying of like relationship business, right? It's not just about putting offers, disappearing. It's about keeping the open line, having the relationship, staying in front of everyone.
I think you do great at that. You're very communicative. Like we've chased deals from Hampton Avery, and then the swing has happened, things have happened, your insurance has happened, and you've never hidden from that. You've been always straight up and honest, and I love that. That's the way to be. Say, hey, I love the deal. I wanted to be here. My insurance came in at $2,400 a unit. That kills my cash flow. I can't do the deal right now.
Yeah.
Can you help me with another insurance broker? Which we did. Say, talk to this guy or talk to this guy. So that is a critical factor. And I think a lot of younger people don't understand that. They just disappear. They go into the fetal position, and that kills them for the future, because then the brokers and the lenders, they don't want to waste their time.
Exactly. It's actually almost like everyone's working together in this environment to get a deal done. Yeah. It's not even about competing. It's about like, hey, can we all work together to make a deal happen and get it done? And being on, just what we were saying before, being honest, saying like, this is how I'm underwriting the deal. This is what we have going on. This is our fund. These are the returns we need to hit. And like, it is what it is.
Yeah, let's get a deal done.
Let's get a deal done. Yeah. So, and you guys have been integral in helping us.
We see ourselves very much as an extension of our clients. We don't see ourselves as your broker. We see ourselves as as we're part and parcel with you. We're in the trenches with you. I think that's what makes us, I think, thank God, so good, right? Because we're out there with you fighting that fight. We want you to win the deal, obviously. We also want you to make the right deal for your investors. So I think that vision of us as an extension of our clients makes us so successful. I think guys that just think, oh, it's one deal and gone. Anthony always says it's never about the deal. It's about the people. And I remember that from my first day chasing deals. Don't chase the deal, chase the people, chase that shared, unified vision.
Yeah, we'll rename the pod People Flow Friday instead of Deal Flow Friday. Yeah, so I guess we're starting to all plan for NMHC, right? And booking our meetings. What's your expectation heading into NMHC? What do you think the sentiment's going to be? What's your thoughts going into it?
I think the last 3 national multi-housing conferences have been all the same, that everyone feels that we're taxiing. We're on the runway. We're taxiing. We're not getting faster. We're not getting up to take off. I think it's going to be another year like that, right?
Yeah.
With rates where they are. I think everyone's very bullish with the new administration coming in, and especially this kind of administration that is kind of a little revolutionary in their thinking and wanting to change things in a big way, from Elon Musk coming into Vivek to all these different people coming into very varied cabinet. You've got hopefully Howard Lutnick will be Secretary of Commerce, and he's a brilliant man. And you've got some really good people. So I think there'll be a very bullish outlook. Obviously, it very much depends on where rates are and what happens with treasuries. So while everybody will be a little bit more optimistic with the new administration coming in, I still feel that people will be very cautious, and it's going to be another runway year.
Yeah, I think last year you had the optimism, and then treasuries ran and it all got thrown out the window.
Yeah.
So I think people this time around are a little bit more cautious.
And I hope we don't have as many of I've got a fund for distress meetings.
Yeah.
We had so many of those meetings last year and the year before. My fund is ready poised to jump in, and they've been waiting poised to jump in for 2 years, and nothing's materialized in a big way on that side.
On the bright side, you will see a lot of deal flow. I mean, so many of these investment sales brokers are just holding off on launching deals as usual. And hopefully we see rates come down a bit in the new year. I mean, it's blown up 40 basis points the past 2 weeks. So
yeah, maybe we tie something up now and get another bond
interesting
rally.
because I'm sure these brokers are having conversations with the seller. Hey, we're going to launch, this was our strike. It might come on the low end.
Yeah.
Hopefully you see rates come down and people actually hitting that low end. So
yeah,
I think
a bit of optimism there.
I think Trump coming in, he's made it very clear that he wants lower rates, and he's a bull in a china shop. He's going to get his way, even though they're independent, right? I think he's already threatened to fire Powell, and Powell saying he's not going to go. So I think there'll be a meeting of the minds in some way, and Trump seems to get his way, as so evident by Canada yesterday, allocating a huge amount of money for budget security, for border security because of tariffs. So I think he's going to push very aggressively to have rates come in. We'll see what happens.
Yeah. What do you think is the sweet spot of where treasuries need to be or where rates need to be for deals to get done? Sub 4. Yeah, I agree with that. I think when you saw that rally come in August, September, that's where you started to see people get off the sidelines.
And people can refi, right?
Yeah.
People can refi. Let people refi their deals, go from their floating rate loans into fixed rate loans. It will create a lot of solidification within the market, and people will be calm, right? A lot of guys are thinking, okay, I want to keep growing my portfolio, but I've got this anchor around my neck. I've got this floating rate debt. I need to get out of it. But how can I go from floating rate debt into 6.5%, 7% debt? That doesn't work for me. So sub 4, get the refis done, and then focus on acquisitions.
I agree.
Again, I don't think we're too dull on the market. We love the market. We think there's a lot of opportunity, but we do want to see rates come in, obviously.
Yeah. You guys obviously very active also on the equity side, and you're talking to JV partners all the time. What you saw this year is a lot of them were on the sidelines or, like you said, going into recapping or rescue capital. What is it going to take to get some of these JV players off the sidelines a bit more and coming in similar to what we saw pre-rate hike or even pre-COVID?
It's not going to be easy because a lot of these guys are taking severe losses, right? A lot of these guys who are super active in 2020, 21, 22, their equity is pretty much wiped out on those deals. So they're hurting and they're scared, and they're going to want to partner with excellent sponsors, guys who also have a good amount of skin in the game. That 95.5 that's gone. I don't think that comes back for a very long time.
You're talking about co-invest.
Yeah.
95.5.
But yeah, that LP of 95.5, that kind of is done in my book. Because look what happens with Tides and all these other groups that just severely shit the bed. I think that's going to leave a long recovery time for the equity guys to right size and feel good about themselves. I think they're also going to see treasuries come down as well.
Yeah.
Rick, you spend a lot of time talking with equity. Are they not telling you? What are they telling you?
They're all very inactive, right? They're incredibly liquid. They're all still selling to, mid-teens returns, 7 yield on cost upwards. I think they need to come down from that. And
Yeah.
it's kind of a herd mentality on equity. So what drives that? It could be interest rates. It could be markets and growth. I think Columbus is a market we discussed where you're seeing positive rent growth. But there's not much of a story in a lot of these markets, and you're kind of seeing them be conservative. That said, they have, these funds have a life. So
yeah, and they have to deploy, right? They have to make investments because that's how they get paid. So they can't sit on hundreds of millions of dollars and not do anything. So they're going to pick their spots. They're going to be smart, but the buttoned up groups will be able to take advantage of it. And again, finding that needle in a haystack, finding that great deal, it's going to generate excitement.
I think you'll see them get more aggressive on recaps as opposed to
for sure.
So,
For sure. I think you're seeing that already. And the JVs are still active, but it maybe not necessarily in multifamily acquisitions, right? It's either on the multifamily side, it could be recaps or things like that, or they're just investing in different asset classes, industrial, data centers.
You hear that over and over again. It's like, buy this empty office in the middle of Los Angeles. I'm like, good luck.
Yeah, and multi-asset class is starting to feel a little bit dull to some of these JV, at least on the acquisition side, until some of the supply is absorbed and some of the fundamentals come back a bit. But it's also a great buying opportunity for those who don't need to rely on JV equity to buy a deal.
Hence we come back to setting up a fund, having equity sitting there ready to go.
So how's that gone for you guys?
It's been great.
Syndication side, you guys are phenomenal too. You just did one LinkedIn post and got oversubscribed in 2 hours. I remember that.
Edgewater was
that was great.
That was
short
great.
like $3 million, and you put a LinkedIn post, and then boom, it all came flying in.
And I think part of that was also like the distressed angle. It adds time of the essence element to it. But it's been great. Thank God. We've done well for our investors throughout the inception of the company, and we have a lot of repeat investors. It's not like we're just coming out of the limelight a couple years ago in the peak of the market and started going on a buying spree that may or may not result in returns. So we've gone through downturns as a company, so we have a lot of existing partners through that, and they trust us.
Max also timed the market brilliantly, and he exited California, and he started moving into our market, the Denver market, Colorado market, the Portland market. So you've got a guy at the head there that really knows what he's doing, which always inspires confidence.
Yeah, Max and Mitch and Farhan, brilliant people, brilliant mentors. And one of the things, I guess, when I started almost 10 years ago at Tryon was a focus on untrended return on cost and untrended metrics, and really is another way of saying protecting your downside. Correct. Right? Don't bank on rent growth and lowering your exit cap to make a deal work. And it was tough to internalize that when you're in a bull market for so long.
And rents are growing.
Rents are going every year. When is this going to stop?
Yeah, but it's good. It's good learning. Right. So now when things are down, you really understand how to make money in this market.
That saved us.
Yeah.
That saved us in a lot of our deals. So I think investors understand that too. And that's why they continue to invest with us on our deals. Yes, there isn't as much liquidity as there was pre-rate hike, where you can raise $20, $30 million equity checks every other week, every other month. So it's definitely slowed down, but we still have our committed existing investor LPs, whether it's institutions, foreign capital, family offices that trust us. And it goes, again, back to what we said in the beginning. It's all about relationships. It's about who you're investing with.
Are there any deals you guys are looking at a recap and any creative structures?
Well, I brought Max, I think, a pretty creative recap structure on the DST side, I said he should be looking at some of the properties and seeing if they work for a DST, because obviously he wants to grow the management company, which I think is such a great thing to do, right? That's just good revenue and
it's great,
smart, and gives you another vertical, which you already have. If you have great regionals and you have great people working for you, and you've got 3 properties, but you could add 3 more properties under that same umbrella, and that's just good cash flow for you. Why not do that? So management is a great way to drive and build your vertical.
Yeah, and it's from a qualitative perspective, right? It's by no means are we making money from in-house management, but we have our finger on the pulse, we are hands-on,
And we have the capacity.
Yeah,
so why not?
Exactly. So it's being vertically integrated, like it really does pay its dividends in other ways. It's not really to just make money. It's to really just make sure that the business plan's executed correctly.
It's a great soundbite for investors, because investors are like, why would I invest with you and you're just going to hand over the management to some third-party firm? You're just going to asset manage. That's never a good soundbite, right? They want you in the weeds. They want you to know every blade of grass, and that can only be done by self-management.
Yeah, and we've embraced technology really well, ARUM and pricing software and different ways to just make the processes more efficient. Sometimes can be a learning curve at times, but in the long run, it pays its dividends, just being efficient.
How do you guys choose the team, like the actual boots in the ground management team?
We use recruiters. We've also, when we're buying deals, we're interviewing the staff, and if the staff is good, we keep them. And honestly, even if a property might be mismanaged, it's not always the staff's fault. It's just about repositioning the property and the strategy better. And there's a lot of dedicated people who love their properties that they've been working in. So we've done a good job retaining staff as well.
I find that when you tour these properties, especially us who have toured so many properties, I was just in Denver a few weeks ago touring a property that was being bought by a client. And then you walk through the property and you have a manager that knows the answers. Everything is at the touch of his or her finger. That to me is very impressive. And then when you have a manager that doesn't know what the hell's going on, doesn't have the answers, you say, "Oh, I'll come back to you on that." They've lost the key to the pulse, right? Yeah. They're not on it. So that's a very good way of knowing who you want to keep on and who you don't want to keep on.
Exactly. And it's not just the manager, it's maintenance staff and making sure that
things are
handled properly in the right way too.
Reviews are so key, right? Because what do you do before you move into an apartment complex? You read the reviews. And if those reviews are bad, that kills you. That just kills you. So I've always said this to my clients, be on top of it. If a toilet is broken, go fix that toilet. Don't take 3 weeks to get it done. If there's a leak, take care of it. Be responsive. Multifamily or property is a living, breathing organism. It has to be fed, has to be loved, has to be nurtured, has to be looked after. And if you don't, it's going to run into disrepair, and then no one's going to want to move into your property. No one wants to move into property. You don't have any competition. You can't push rents. It's a disaster.
The intangibles that's beyond the P&L and rent roll is really what drives a successful investment.
1,000%.
It goes beyond the numbers.
Yeah.
So
you're in the service business. You're providing a product, right? So just buying it, your job only starts when you bought it. So many people think, I'm going to buy the property and I'm set. Bullshit. Sorry. Not true.
You can say bullshit. It's okay.
Your job starts when you close. That's when your role starts. How your staff works, how you integrate with your tenants, how you keep your tenants on the property. The turnover in some of these states are 50%. That means repainting, re-tenanting every year, 50% of the units. If you can bring that down by a fraction, even that tiny fraction, and be 40% turnover, that's going to save you so much money. So keep your tenants happy, create a community within your buildings, foster relationships within your buildings, and people will stay for longer. And I think Joe Lubeck does such a good job of that. I think he's so good at that, right? American Landmark is so good. Harbor Group is so good. Some of these firms are so good at maintaining their tenants by creating and fostering in relationships within the buildings, be it camps for the kids, be it barbecues, be it activities, be it after school learning programs. All these little things really help create not just a bland apartment building, but a real community. And relationships are made, little kids become friends, parents become friends, school runs are established, and that makes it much harder for you to leave when your lease is up and you'll just renew and stay.
Exactly. It ends up getting into the financials with retention and with things, but it starts from the intangibles and the personal touch. And I would also add, your clients that you're just naming, when we're looking to buy a deal, and they're the seller, we're like, wow, that's going to be a good property to buy. We know there's not skeletons in the closet, and that goes a long way too, right? And from the other side of the coin, if there's a bad client, none of your clients, but if there's a bad seller, you're like, okay, that rent roll is probably not real. Those P&Ls are probably not real. We should
But
probably,
there's also then there's usually an upside, right? Because you know a bad seller, he's not done a good job, he's not kept his people happy. You can come in, clean that up, say under new management, put that everywhere, signage everywhere, on every website. It's new management taken over. Start responding to those reviews. Say, hey, we are the new management. We're so sorry to hear this. We're going to be here for you. You're going to have
there's
one.
upside.
Yeah, there's upside there, right? And when you see the new management come in and start responding under those reviews, saying, we're the new manager. We're here to help. Please contact me. You read that and you're, oh, these guys are on top of their game. I'm going to move into that building.
Yeah. But you got to get paid for that upside, right?
You got to make sure that you're making money on that upside.
So you're saying, all right, maybe I got to pay a little less because this is going to be a lot more work. And one thing we're practicing at Tryon is also return on headache, right?
Right.
We need to make sure that not only is it a good return on investment, but it's a good return on headache.
Life is not easy. The bigger the headache, the bigger the reward.